In the last chapter, we talked about the adjusting and closing entries that are needed in any type of company. And you basically do the same thing for a merchandiser as you do for a service company. The only difference really is that, you still have to do adjusting entries for your prepaid expenses, for accrued expenses, unearned revenues, accrued revenues. The one difference is that in a merchandising operation, if you're using a perpetual inventory system, there's one other adjustment you have to make, and that's for shrinkage. Shrinkage is the term we use for the loss of inventory. And this is often through theft or deterioration. We all know how that can happen in a company, that something gets broken or a package opens and it can't be sold, those kinds of things. So typically you take your inventory figure that you have on hand, that you've calculated just by adding purchases and subtracting sales, and then you do a physical count. And in some companies that's done every month, and other companies it might only be done once a year. But this is an example. Their inventory account says that they have $21,250, but an actual physical account reveals that only $21,000 of inventory exists. There's a difference of $250. So the entry to take care of that is you would debit cost of goods sold, and you would credit merchandise inventory, because you don't have this amount, you have 250 less of that. So to reduce merchandise inventory, we have to credit it. So this is one other adjusting entry that has to be done for a merchandising operation. Now, the financial statements are going to be pretty much the same. You're just going to have a couple other accounts on there that you wouldn't have if it's a service industry, such as the income statement is going to have cost of goods sold on it and gross profit. Also, you're going to have things like discounts and returns and allowances that are going to be on there, and maybe a transportation expense account, things like that. The balance sheet will have inventory on it, where you wouldn't have that if you don't have inventory in a service industry. The statement of retained earnings is the same, but you're going to have some differences on your income statement and on your balance sheet. So your closing entries are pretty much the same. You have adjusting entries we just talked about. Your closing entries are going to be pretty much the same as a service industry. You're closing your temporary accounts, but you're going to have some additional ones now. So some of those temporary accounts that are unique are going to be the sales account, the sales discount, sales return and allowances, and cost of goods sold. These mean that you have to close these as well. So let's look at that here. The sales account has to be closed, and we close it to income summary. So you would debit sales and credit income summary in this situation. And these are the accounts that have normal debit balances that are going to be closed to income summary. And you see here that we have sales discount, sales returns and allowances, and cost of goods sold, as well as all the different expense accounts. So they also get closed to income summary. And then, as we already talked before, income summary then gets closed to retained earnings, and dividends gets closed to retained earnings. So you would have pretty much the same type of closing entries, you just have a few more accounts that you have to do. So this is a good summary of the entries that have to be made for any merchandising entity. If you're purchasing merchandise for resale, or paying freight cost on purchases when it's your responsibility, when you're paying within the discount period, and then how do you record purchase returns or allowances. This shows you the basic way to do those types of entries. And then these down here are for sales. So this is in the day-to-day course of action. You're buying things or selling things. This is how you go about doing it. What the debit is to and what the credit is to. And then your adjusting entries are shown here. Adjusting for shrinkage is a debit to cost of goods sold and a credit to merchandise inventory. And then this is how you close those extra accounts that you don't have in a service industry. So this is a good chart to look back at to understand how you go about doing these. But that's the basic approach to handling entries for a merchandising operation.